Hello everyone, my name is Zikang Chan, the expert tutor for AFM. This topic explainer is about risk management with futures contracts part 2, basis risk. Before continue watching the video, it is important to take note that you are strongly advised to watch risk management with futures contracts part 1 before watching the following part of the video. Guys, the explanations on basis risk in this video, it's mainly referring to the following ACCA learning resources, primarily the Study Hub from chapter 14 and 15 in section 15.2.3. By referring to the Study Hub landing page on the left-hand side of the tab, just select chapter 14 and 15 for reading. Particularly by clicking into chapter 15, you will get into section 15.2 and you will just go into part 3 on interest rate futures. In this sections, explanations will be given on interest rate futures and especially the explanations on basis risk. Last but not least, other than the Study Hub, technical articles titled Basis Risk, as well as practice exam in the practice platform are highly encouraged to be used by the students in getting yourself familiar with basis risk in this video. In this session, I'll explain the basis risk by commencing from the understanding and also a recap regarding the way that futures contracts were used for hedging purpose. And that will take you through from the beginning to the end of it. But of course, the purpose of this video, it is to draw your attention to particularly looking into the processes and also the understanding on figuring out and determining the basis risk in the usage of futures contract. Finally, this video will also take you through with one of the examinations questions for basis risk. In the earlier video, these are the basic rules for the trades on using futures contract by creating an account, going into the trading with the help and the assistance of the broker to enter a trade order, either to buy, in other words, long, or to sell, in other words, short, on the futures contract with the anticipations on the adverse movement in the prices of the underlying assets. It is important for you to take note. It is not the intentions of this video in showing the processes in determining to buy or to sell, but again, it is more focusing into the mechanism of understanding and also determining and quantifying the basis risk along the usage of futures contract. It is worth to just get recall in order to start trading on the futures contract for hedging. The initial step to get ready to trade, such as opening of a trading account or margin account, as well as placement of initial deposit or margin, should be borne in mind. Once it is ready to trade, through buying or selling the futures contract, that is what we have said, the creations of hedging position. And this is what we have mentioned in the earlier video. In buying and selling the futures, it either refers to currency futures, if it is mainly used to manage the foreign exchange risk. Alternatively, it is also to buy or to sell 3 months interest rate futures, if it is therefore to use in managing the interest rate risk. Once the trade order is commenced, it will be executed at the price of the futures contract now, let's term as P1, based on the number of contracts that is sufficient to provide the hedge on the underlying transactions. Guys, it is important for you to understand in this part of the video, when we or the hedger creating a positions on the futures contract for the hedge purpose, it is possible once the hedge is created now, to estimate the outcome of the futures contracts as the hedging instrument by estimating or predating the estimated lock-in rate, which is reflecting the estimated payoff or the end result with the usage of futures contract. The estimations on ELIR or estimated lock-in rate, it's playing the roles to make a comparisons against the payoff or the results of all other available hedging techniques as spelled out in the exam questions as the basis of making a comparison and also therefore a basis of selecting the optimal techniques of hedging that form part of the recommendations for hedging strategy. So therefore, it is important for you to understand the calculation and the estimation of estimated lock-in rate, which therefore trigger the appearance and the relevance of basis risk in the later part of the video. Here we go. Referring to the notes on asterisk, the calculations of ELIR for both the currency futures, which is called CF, and interest rate futures, IRF, is pretty much similar by looking at the price of the futures contract at this point of time now, which is always referring to the P1, and P1 is normally provided in the examination's questions. The other numbers required in estimating the ELIR is the estimated basis, which denoted by EB. And this is the number that students are required to know how to derive it based upon market data given by the questions. And taking note, the estimated basis can be either positive in value or negative in value. And therefore, the signage of positive or negative sign is of essence in order to ensure the calculations of ELIR is accurate. Because by adding between the price of the futures contract now and also the estimated basis, should the basis show to be negative, the ELIR is the net of results between P1 and EB. Whereas if the basis is turned out to be positive, then the ELIR is the total of both the numbers. The ELIR is not only serving as the reflections on the estimated result of using futures contract as a hedge, but also the ELIR is particularly useful for currency futures. In some of the example or examinations questions, the ELIR, as indicated in the double asterisk as shown above, it could be used and it needed to be considered in determining the number of contracts for the futures to be traded, especially when there is a need to convert the currency of the underlying transactions to become the same as the quoted currency in the futures contract in order to estimate the number of contracts that need to be traded. So guys, once the futures positions has been created and open, what's next? As we have mentioned in the earlier part of the video, in between now until the transactions take place, there will be the process on mark-to-market, which is not the main part of this video, but it is already covered in the first part of the video. What happened after this is that at a later date, when the underlying transactions took place, and this is where that the hedger, which is the company, will need to enter a reverse trade order, which is called close-out action. Regardless of the outcome of the price movement on the underlying asset, the reverse trade order is simply referring to when this futures positions is to be closed, this trade order would involve in either selling or buying the future. Just a reminder to you, should a future position is created at the beginning of buying the futures contract, then upon closing out, the hedger will then need to sell the futures to net off the obligations earlier. Vice versa, if the futures contract were to be sold at the beginning, now it will have to buy. So when we enter a close-out transactions on either currency futures or the 3 months interest rate futures, these trading will be executed at the price of this futures contract on the later date when the physical transaction or the underlying transactions is taking place. And given the fluctuations in the price of the futures contract at times to come, let's assume that on the close-out transactions date, the price of the futures contract is quoted at P2. Guys, it is worth to take note. In certain part of the exam questions, P2 may not be provided. However, in certain part of the questions or certain type of exam questions, the P2 will be provided. And you need to know what is there to calculate when P2 is not provided and P2 is provided. And not to forgetting, this closeout transaction must still be based upon the same number of contracts as entered earlier. So what happened when the futures contract's position is closed with this reverse trade order? Let's take a look at the following. The mechanism of this closing out action, it is aimed to derive the gain or the loss from the trading of this futures contract. If P2 is not provided, there is no need for the students to calculate the actual gain or loss from such close-out action. However, if the questions come with P2, you may need to show the calculations on the actual gain or loss on this futures contract for both currency futures or interest rate futures. What you have to do, it is to compare between the price that we enter the trade at the beginning, which is P1, against the price that we execute for closeout, P2. The differences of these prices would reflect either a gain or loss. To determine the total amount of this gain or loss, we just need to multiply the contract sizes and therefore multiply followed by number of contracts. And let's not forgetting, for interest rate futures, there is another factor that to be multiplied, which is the time factor, which is usually based upon 3 months over 12 months period. Once this product is derived from the above calculation, the gain or the losses will then be derived with this calculation. And what happened to this gain or loss thereafter? And the answer is that the hedger will need to consider what is the actual outcome from the actual transactions that took place later at the spot rate. For foreign exchange risk management under currency futures, the actual outcome on this transaction is therefore referring to the actual payment or receipt of the foreign currency settlement. As for interest rate risk management, the actual outcome on the transactions is therefore referring to the actual borrowing interest to be paid or actual return on investment expected to be received. Once the actual result were found and combining with the gain or loss, the net results for foreign exchange risk, it is called net payment or receipt. For interest rate risk management, the net result is referring to the net borrowing interest or net return on investment. These net outcome will be reflecting the actual rate that derived with the usage of the futures contract. And these actual rates at the end would usually be different from the lock-in rate that we estimated earlier at the start of the hedge. Why is there a difference between the actual rate and the estimated lock-in rate? It is mainly because when we estimate the estimated lock-in rate, the second component, the estimated basis, is derived with the following assumption. When estimating the basis, which is the EB, it assumes that the basis is declined at a constant rate from now until the expiry of the futures contract at a constant rate. So from now, the basis is such amount. As times approaching to the expiry of the futures contract, the decline of the basis is constant right until the expiry date of the futures contract. The basis becomes zero. Whereas, in actual fact, the movement of the basis, the movement of the differences between the price in the spot market and the price of the futures contract, it is not moving constantly, but it is moving in the disproportionate manner. The differences in these assumptions as comparing to the actual movement of the basis, it's therefore explaining the emergence of the basis risk. So this is the basic understanding to explain what exactly basis risk is all about. So before we take a look at the following exam questions, it is good enough to recap in summary what basis risk is all about by referring to the following paragraph extracted from the article as mentioned in the earlier part of the video. So with these explanations in the earlier part of the video, by reading up these explanations in the article, you should get a better understanding on basis risk. Now, it's time for us to take a look at the following exam questions. Firstly, looking at the requirement, our focus in discussing the basis risk is mainly relating to part C, which is asked to explain what is the meaning of basis and what's the meaning of basis risk. And then we have to discuss the impact of the basis risk on the hedging decision that is derived from part A and B. So in order to demonstrate basis risk, as we have discussed earlier, it is important to know how the futures contract is created for hedging purpose. That is what part A is asking for. The hedging action is mainly used to come up with a hedging strategy for a transaction that is worth 18.25 million euro as a payment. And we are asked to refer to the market data on 1st March to demonstrate the evaluations of all types of hedging techniques. Guys, it is worth to take notes that is the last sentence in these requirements, the highlighting an assumption showing basis diminishes to zero at the contract maturity or expiry at a constant rate. That is exactly what we have described about the basis to estimate the basis. Whereas now, other than the assumptions that were used to derive the estimated basis, it also assumes the actual basis is moving in the same pattern. When the assumptions of such basis movement is made, it means the estimated basis and the actual basis is the same. There is no error in the prediction. With this kind of assumption, it simply means we assume there is no basis risk. And guys, in order to demonstrate the calculation and the discussion on the basis risk, let's take a look at some of the general information from the first exhibit in these questions. It is worth to remind you that it is highly recommended, apart from watching this video, you should give a try to walk through and produce the full answer in detail on these questions in order to fully appreciate the full range of the knowledge on managing foreign exchange risk. First of all, this company F is located in the US and today is on 1st March, which there is a plan to hedge on a target payment, a planned payment worth 18.25 million euro that will take place on 1st August. The following are the market data on the 1st March, which is now, including the spot rate and also market data of a few other hedging instruments. To demonstrate the basis risk in this video, the focus is only looking at the currency futures, where there's only one currency futures, namely September futures contract, are given due to the fact the transaction will take place on 1st August. We need a futures contract that is still remain valid by then. So September futures will be a good one to use with the price trading at 1st March with the price of $1.156 per euro. With this information, you need to know how to create the hedge on 1st March. So based upon your knowledge that you should have learned it, grab it from Study Hub that tells you how to determine the trading action to buy or to sell, and also the knowledge from the Study Hub that advising on how to determine the number of contracts. To create the hedge on these questions, the company will need to buy the September dollar per euro futures for 146 contract at the price on the futures contract as given. As mentioned earlier, once the hedge positions or the futures contract is already created, we should be able to predict what is the estimated outcome by deriving the estimated lock-in rate from these action plan. So based upon the following diagram, that is the way to derive the two data, the two numbers that needed in deriving the estimated lock-in rate. Do you still remember which are the two? Firstly, we need to know the price of the futures contract now. Secondly, we need to estimate the basis. To estimate the basis, this table is to facilitate the understanding and the calculation by showing two prices at this point of time. One, the spot market price, spot rate. It is worth to take note by looking and referring to the spot rate today. There are two rates provided, the buying and the selling rate. Guys, you are advised to read up the Study Hub to improve your understanding on how and why the selling rate is selected in the calculations over here. So, by looking at the selling rate on 1st March, it is quoted $1.1497 per euro, and at the same time, the price of the futures contract is given at 1.156. These prices clearly showing a differences of negative 0.0063 dollar per euro. Why is there a difference in such pricing? It is mainly because the spot rate reflects the perceptions on the value of each euro at this point of time in the market, whereas the price of the futures contract reflects the perceived value of each euro that it worth on the end of September at this point of time. In other words, the price of the futures contract tells what people believe these euro worth at the end of the September at this point of time. So clearly, these pricing represent the perceived value of the euro at two different points of time. One on the top is the price now. The second one at the bottom is the perceived value of the price when the futures contract expires at the end of September. Clearly, on 1st March and end of September, there is a timing difference of 7 months. Because of the timing differences, it is natural that we expect to see a differences in the prices due to two different series of point of time that will derive the value based on different state of factors that people will consider. The difference in these two prices is therefore called a named basis. Given that both the price are the actual data provided in the questions, this basis is therefore the actual basis. Once the actual basis is known, as we have discussed earlier, as time goes on and approaching to the expiry of the futures contract, the amount of the basis will be getting lesser and lower until the maturity, the expiry date of the futures contract at the end of September, the price on the spot rate and the price of the futures contract should be the same, given that these two prices are on the same point of time, no timing differences. So therefore, the basis will therefore come to 0. But the question is, in between 1st of March and end of September, in between, what happened to the basis? Especially on the day where the transactions take place on 1st August. Unless the questions provide both of the rates in the exam questions, and then you will be able to derive the actual basis. However, if both of these prices are not provided, which is usually the case when we are here at this point, we haven't moved on to 1st August, we have no way to figure out what these prices are. So in the absence of these prices, we have no idea what the actual basis is. So therefore, based upon the assumption saying that the basis from now until the expiry date of the futures contract, we assume it will be declined at a constant rate. This is the assumption as mentioned earlier. With this assumption, the following formula will be used to derive and estimate what is the estimated basis on 1st August. Given that with the 7 months timing differences, the basis as shown earlier was negative 0.0063. Now with 2 months to go from 1st August to end September to reach up the maturity date of the futures contract, with these 2 months left behind, you will get the estimated basis of $0.0018 per future. Bearing in mind, this is the estimation on the basis with this assumption. So once we found the estimated basis, according to the formulas on deriving the estimated lock-in rate of A plus B, the A refers to the price of the futures contract now, the B is simply the estimated basis. Combining both together, it is worth noting the basis in this case is negative. So when you combine together, the estimated lock-in rate is a net of results of $1.1542 per euro. Will this estimated lock-in rate be accurate? That depends whether the actual basis and the estimated basis is the same. To prove this is what part C of the questions is asking based on scenarios provided. Before looking at the following, it would be good that students will just refer and understand information provided on the scenarios. So this will be the second exhibit showing us the information on the two scenarios of the exchange rate that now found on 1st August. Taking note, these are the rates that found later on 1st August. And under scenario 1, this is what the part of the video is focusing on. After watching the video, please go back, give a try on scenario 2. In scenario 1, the spot rate is given as follows, and take note, we are looking at the selling rate. And the price of the September currency futures is now moved to be $1.1552 per euro. So with this actual data, we will be able to derive the outcome of the hedge based on scenario 1. So on 1st August, we would just have to enter a reverse trade order of selling the September future for the same number of contracts based on the price given in scenario 1. So with this reverse order, we will be able to come up with a summary on the trading of the futures contract. Firstly, we bought the future at the price 1.1560. Later, we sell the futures contract at 1.1552. We bought at a higher price comparing to what we sold at. That is clearly a loss making of $0.0008 per euro. Multiplying with the contract size and the number of contracts, that gives rise to the total loss on the futures contract. Combining with the actual result on the actual payment for the 18.25 million euro at the spot rate. That will turn out to be the actual payment in dollar, 21.04955 million. Combining both of these payments, the net payment will come up to be 21.06415 million. Converting these amount of the payment in dollar based upon the transaction's value in euro, we worked out the actual rate, or we call the effective rate, of 1.1542 dollar per euro. And now you are comparing to the estimated lock-in rate. Guys, what do you notice? By chance, coincidentally, both rates are the same. So what is this conclusion telling us? It shows us the basis risk in scenario 1 does not affect the accuracy, the outcome of the hedge, and therefore it does not affect the validity of the recommendation of the hedging technique. What you should do, go and try scenario 2 and let's see if both the rates are still the same. If it is proven to be different, then the conclusion will be the basis risk will affect the outcome of the hedge as such. Guys, with this part of the video, I hope that will give you a better and a clearer understanding of the processes to understand basis and determining, evaluating basis risk as far as futures contract is concerned. With this, good luck in your examination.